Hello dear viewer, thank you for tuning into my channel. In this video, we are coming to consider the Consolidated Statements of Profit or Loss and other comprehensive income. In my previous videos on consolidation, we looked at the Consolidated Statement of Financial Position, where we considered how to prepare that consolidated financial statement and any adjustments that are needed to make your consolidation work. So in this particular series, or the part 2, I will name it the part 2 of our consolidation series, we are looking at the Consolidated Statement of Profit or Loss and other comprehensive income. If you are already a subscriber to my channel, thank you very much for sticking to the channel. If you are new on the channel, please subscribe to the channel and also consider liking the video and sharing with others so they can also benefit from what you are enjoying here. Alright, so let's get back into business. So the Consolidated Statement of Profit or Loss, the principles behind this particular financial statement is not too different from those we've seen previously under the Consolidated Statement of Financial Position. So quickly, we want to look at what the basic principles are. So the basic principle is that we are adding the income and expenses of the parents and the income and expenses of the subsidiary or subsidiaries, if there are more than one, from revenue, which is the first line item on the statement of profit or loss, down to other comprehensive income, or the statement, the profit for the year, if it is only the Consolidated Statement of Profit or Loss. So that is the basic principle. And then secondly, after calculating the profit for the year, we will show a split of the profit between the amounts attributable to the parents' shareholders and those attributable to the non-controlling interest. And the purpose for doing this is to reflect the ownership position. We know that these are the owners and these are the non-controlling interests. Alright, so that is the purpose for doing this. The purpose for adding all of them, the income and expenses, and then the of both the parent and the sub, is to show P's control over S, because P is the parent, S is a subsidiary. They are trying to show their results as a single economic entity, with P being the parent, the one who is controlling the subsidiary. So that's the basic principle of Consolidated Statement of Profit or Loss. Now let's go to the mechanics. Just as we have in the Consolidated Statement of Financial Position, with the Consolidated Statement of Profit or Loss, it is also common to use a standard approach. Okay, so what is the standard? As usual, just like we have in the consolidated balance sheet, we will establish the group structure. What is the group structure? We discussed it in our previous lessons. Alright, then secondly, pro forma statement of profit or loss will be prepared, and this is done by combining or adding the income and expenses for both the parents and the subsidiary or the subsidiaries, if there are more than one. And then thirdly, we are going to look at any workings for any adjustments that may be detailed in the question. And such adjustments may be a provision for unrealized profits, fair value depreciation, dividend payments, interests. Alright, all of those adjustments need to be made in our Consolidated Statement of Profit or Loss. And then as a final working, we will calculate the non-controlling interest share of the profit of the year. And how do we do that? We are going to look at the sub's profit or the subsidiary's profit after tax, and then we will adjust it for any fair value depreciation, provision for unrealized profit where the subsidiary is the seller, and then impairment of goodwill where the fair value method of measuring NCI is used. And then after that, we will get an adjusted profit the subsidiary, and then we are going to strike the NCI percentage on the adjusted profit to get the NCI share of the subsidiary's profit for the year. And that is the reason why we are having the split here. This amount that we get here, the percentage amount here, is the amount we are going to use for the splitting between the parents' profit for the year as well as the non-controlling interest for the year. Alright, so that is that for the mechanics. So let me go over the mechanics again. What do? We establish the group structure. The group structure is talking about the percentage holding of the parents in the subsidiary, the date on which the acquisition was made, the reporting date, and all that. That is the group structure. Then we'll look at a pro forma statement of here. We'll read through the question, and then we'll draw up a pro forma statement of profit or loss, where we did in the statement of financial position consolidation series. All right, and then we'll do workings for any adjustments such as provision for unrealized profits, fair value adjustments, or depreciation, interest payments, dividend payments, and all that. All right, and then lastly, we'll look at the non-controlling interest share of the profit. So we'll put all of this into practice, and then you get the understanding better. Now let's look at some of the adjustments that I talked about. So the first one that mostly will be seen in a consolidated statement of profit or loss question is interest and dividends. So how do we treat the dividend? Dividends received from the subsidiary by the parent is deemed as an intra-group transaction and is therefore eliminated in the consolidated statement of profit or loss. So what we are saying is that if the subsidiary pays the parent because the parent is an investor in the subsidiary, that dividend will be eliminated on consolidation, because when we are consolidating, the two entities become one. So you cannot make profit trading within yourself. That is the basis for this argument. So the only dividend income in profit or loss is those from trade investments only. Any dividend from trade investments only is what will be recorded in our profit or loss financial statements. All right, and then the only dividend paid or payable in the statement of changes in equity are the parents. So we are talking about the ones the parent company has paid to its shareholders. That is the only dividend that will be reflected in the statement of changes in equity. Right. So that is how we deal with dividend and interest. Dividends paid from the subsidiary to the parent are eliminated. Any interest on loan that has been paid from either the parent to the subsidiary or the subsidiary to the parent will be eliminated from the groups, because all of these are seen as intra-group transactions. All right, now let's look at intra-group transactions where there are payables and receivables, as we have seen in the consolidated financial position. Now, when it comes to intragroup transactions, whenever intragroup transactions, one of the entities, usually the seller, is going to record sales, and then the purchaser, the one who purchased the goods, is going to record purchases. So in the consolidated statement of profit or loss on consolidation, after adding the revenue figures of the two entities, we are going to subtract any sales that happened or that occurred between the two entities. So as you have seen here, I have put here P's revenue will be added to S's revenue, and then we will less any intragroup sales. on consolidation of the cost of sales, we will add the parent's cost of sales to the subsidiary's cost of sales, and then we are going to subtract any intra-group purchases. Remember, the sales is the purchases. The sales in one entity is the purchases in another entity. So the basic idea is that intra-group trading results in the sales of one group entity, as I've already said, and purchases of the other entity within the group. Thus, when we simply sum up the sales and then the sales figure of the two entities, we will be overstating the figure. That particular figure will overstate it by the intergroup transaction that has occurred. All right, so that's why we are eliminating any of those items within the consolidated statement of profit or loss. Now, the next item we'll be dealing with or we'll be seeing is provision for unrealized profit. This is treated similarly to the consolidated statement of financial position, where the inventory remaining in stores is found, and then any profit element is calculated on it and then eliminated from the retained earnings. Here, the retained earnings in the consolidated statement of financial position becomes our profit figure in this particular situation. So whatever adjustments we will have to make would be made. So what we do is that whenever there is an unrealized profit on any sale within the group, that unrealized profit component would increase our cost of sales. By doing that, we are returning the closing inventory back to its true cost to the group, and then we will eliminate the unrealized profit element on it. I will come again. Whenever there is a provision for unrealized profit on inventory, what we do is that we are going to add the unrealized profit on that particular inventory to our cost of sales. Why? Because the inventory, which is both opening and closing inventory, are a major part of our cost of sales. So any unrealized profit has increased the closing inventory. All right, has increased the closing inventory, which actually reduces our cost of sales. So adding it back is going to reduce the effect that the closing inventory had on the cost of sales. All right, and that effect is by reducing the cost of sales. So we have to add it back. What do I mean by that? We have, how do we calculate our cost of sales? So COS is calculated by purchase. We have our opening inventory. We will have opening inventory. Then we'll add purchases. And then we are going to less the closing inventory. So this is how we calculate our cost of sales figure. All right, now this unrealized profit element is included in our closing inventory. All right, and if there is an unrealized profit element on our closing inventory, it means the closing inventory has been overstated. So if you will less this particular amount, if we less the closing inventory from the cost of sales figure, it means the cost of sales figure has reduced more than necessary. So what we are doing is that we are adding any unrealized profit which has reduced the cost of sales back to the cost of sales. All right, and then that is going to bring our closing inventory to its cost to the group. That is the explanation that we are giving to this. All right, so that is just by the way. So that is it. And then lastly, or most importantly, we have the non-current assets. We have non-current assets. Now, whenever the selling price of the non-current assets is equal to the carrying amount at the reporting date of the seller, then no adjustments are made. But where there is a difference, that means that the seller has transferred the NCA to the purchaser, all right, at a profit. And since the non-current asset is still being used or is still being depreciated by the purchaser or the acquirer, the that profit element on it and then the excess depreciation would have to be eliminated, because that is not supposed to be in the consolidated statement of profit or loss, just as we had in the consolidated statement of financial position. So what we are saying is that any profit or loss arising on the transfer must be removed from the consolidated statement of profit or loss, and then any depreciation charge for the buyer, that's the buyer or the acquirer, must be adjusted so that it is based on the cost of the assets to the group. So any depreciation which has reduced the profit of the buyer will be added back. All right, will be added back. So these are some of the adjustments, the most common adjustments you see in consolidated statements of profit or loss. This is an introductory video, so I just introduced you to the world of consolidated statements of profit or loss and other comprehensive income. So we are going to pick a question, we will solve it, and then we will see how we are going to deal with each and every issue that we have seen in the consolidated statements of profit or loss so far. So as a recap, we are preparing the consolidated statement of profit or loss and other comprehensive income as for the two entities, but in this case we are viewing them as a single economic entity. All right, so we are including their income and expenses together from revenue down to profit for the year. And then after doing that, we are going to calculate the NCI's percentage of the subsidiary's profit for the year, and then we are going to use that to split between the profit for the year from the group between the parent shareholders and then those attributable to non-controlling interest. And then I have also given you some mechanics here to help you prepare the consolidated statement of profit or loss. And those mechanics are: first, establishing a group structure, preparing a pro forma statement of profit or loss by combining the income and expenses of both the parent and the subsidiary or the subsidiaries, up to 2 subsidiaries for the financial reporting exam. Take note of that. So we also have workings for any adjustments that we may do, which we have looked at already, and then that is going to end the video on this particular introduction to consolidated statement of profit or loss. Thank you for your time. I will see you in the next video, where we are going to start crunching numbers, and then we'll put everything that we have discussed here into use. So when we enter there and you get confused or get lost, please refer back to this video to hear the explanations I've given so that you can comfortably follow along. All right, I know you will sit up, so relax, and then we are going to get there. All right, so thank you very much for your time. I will see you in the next video.